There's a lot of anxiety in the air along the lines of, is my bank secure? So today I thought we could dissect the recent bankruptcies, the government's announcement of a special rescue, and the reasons why some people are pleased with it and others are furious. And naturally, what comes next? Start by stating the facts. In a short amount of time, 3 significant American banks failed: Silicon Valley Bank and Silvergate Signature Bank. The smallest company at the time, Silvergate, had assets of roughly $11 billion. The smallest was Silicon Valley Bank, while the largest was Signature. Silvergate and Signature Bank are highly recognized in the crypto realm, while Silicon Valley Bank was big in the IT startup area. Despite their variations, these banks all fell due to this, which is a common cause. When too many customers make too many demands, the banks are all subject to runs. If you move too quickly, the banks will run out of cash. Now let me clarify something. It would be simple to compare this to the 2022 cryptocurrency meltdown when multiple crypto firms, including FTX, folded. But there is a significant distinction. Businesses like FTX were bankrupt. They were unable to lend money during the bank run, while the banks we're talking about were illiquid, meaning that some of their cash was locked up in long-term assets like bonds during the bank run. To be clear, these are not the same things. However, the specifics can become a little hazy. For instance, if a bank has to sell assets to cover cash outflows during a bank run, what may have begun as a liquidity issue may turn into an insolvency issue. I'll explain after that. Treasury bonds are regarded as one of the safest investments. Perhaps your grandparents invested in it. Both are investments made by banks for the same purpose. They offer a consistent rate of return. Let's say the Signature Bank, yes? Customers' assets total billions of dollars according to you. What do you do with it? Government bonds, which, let's say, yield 1% annually. Although you keep some cash on hand for withdrawals, you reason that if you ever need to sell these, you can sell your bonds. Nevertheless, what would happen if interest rates rose dramatically? You recently purchased a 5-year bond that pays you 1% annually, but as a result, the government is now selling the same bond and providing 5% instead. Your bond's market value is now declining. Due to the lower interest rate, it isn't even worth what you bought for it anymore. Hence, if you try to sell that, you now lose money. To be clear, if you retained the bond until it matured successfully, you would still make that 1% and sustain no losses. Holding on is not an option, though, when depositors want cash. I realize it sounds confusing, but the basic idea is this. Because of these bank runs, banks were compelled to sell long-term assets like bonds they didn't want to sell and suffered losses. Because of this, what had initially been a liquidity issue turned into an insolvency crisis. And because of this, they were forced to shut down. And because they wouldn't be able to handle all those withdrawals, they were forced to close. Then what, right? Government guarantees for bank deposits, don't they? Why are we even having this conversation? Yeah, sort of they do. Yet, the FDIC only guarantees up to $250,000 per account. In places like Silicon Valley Bank, they had many accounts with much more than that because, as we previously mentioned, they hosted many venture capital startups that may have had anywhere from 10 to 50 million in there. Suddenly, though, that company, which was healthy yesterday, is unable to access that money and cannot make payroll because their bank failed. And this sparked a significant reaction from many in Silicon Valley who demanded that depositors' money be guaranteed. Others, like Jason Kakai, said that you should be utterly afraid right now. The right response to a bank run is to guarantee all deposits up to $10 million against contagion, otherwise the situation will get out of control. And remarks like these generated a heated discussion over whether or not the government should get involved. Depositors will eventually have access to all of their money thanks to the response that came on Sunday when the U.S. Treasury made this statement. You are there. In addition to Silicon Valley Bank, Signature Bank is also being saved by the U.S. government. They did this citing a systemic risk exception, which boils down to a single idea. Please don't panic, guys. Please don't take out your money. Ultimately, the U.S. government doesn't want you worried about your bank deposits. However, not everyone saw this as a win. Many were quick to point out that. Once again, the government only seems to step in to help a certain type of person. Quote, Mark Cuban bailout Silicon Valley Bank tonight. Feds approve. Goldman Sachs needs $824 billion approved. JP Morgan Chase needs a $416 billion approved average. Joe, my wife has cancer. Can we get Medicare? We are broke. However, I must warn you that many who support the Fed's actions will argue that this is an unfair definition and that the exceedingly rich are not receiving a bailout. They'll argue that since only depositors are affected and CEOs and shareholders will receive nothing, this isn't a classic rescue at all. And while that sounds excellent, some Silicon Valley Bank executives and stockholders had already cashed out when CEO Greg Becker sold 3 points. His shares were worth $1 million just before they crashed. Even worse, Greg Becker was one of the individuals who advocated for the deregulation of his bank, which only makes the situation worse. SVB CEO Greg Becker pressed U.S. regulators to raise the asset level at which banks would be deemed systemically important several years ago. So let's be clear about this. Because they weren't seen to be systemically important, they were subject to less regulatory scrutiny. Yet they are structurally hazardous and need to be bailed out when things go wrong. It's a matter of, I've got to have it for me. Again, this is not the same as the full bailouts that we saw in 2008. And regardless of where you stand on the bailout debate, the notion that systemically hazardous banks should receive preferential treatment while regular banks, I guess, don't send a fairly strong message. If you're wealthy, you should put your funds in institutions with too much capital. If you don't, you face the systemic danger of losing all your money.